A short squeeze occurs when asymmetric tails meets forced covering. The greatest example of a recent short squeeze is GameStop, or ticker symbol GME. The GameStop short squeeze debacle in January 2021 brought the term short squeeze into paper headlines when the stock exploded to nearly $350 on January 27, 2021. But this squeeze did not start on January 27th. That is the date the squeeze climaxed, so far at least. For the past several years, GameStop has been a declining brick-and-mortar game retailer. With the advent of online gaming, demand for physical games has fallen significantly since the early 2000s. Thus, it is intuitive that GameStop shares dropped over 94% over the course of 6 years from 2013 to 2019. At some point, shorting GME stock became a low-risk, however rewarding bet, nearly free money. The allure of this seemingly low-risk bet drew interest and transformed into a positive feedback loop. This is not immediately a problem. In fact, it became a benefit for those looking to maintain the status quo of the stock. Firms like Melvin Capital sought to continue the downward pressure on GME and profit. As the trade drew more attention, more players joined in, shorting the stock, driving the price down further, which benefited those already in the trade. Everybody who was short won together. However, as with all systems that rely on equilibrium, there is a tipping point. At some point, the free money machine goes too far and the risk to reward flips, both due to the limited remaining value to harvest and the crowded nature of the trade. GameStop went from being an overvalued to extremely undervalued stock. It was an army of anti-establishment apes and moonboys from Reddit's Wall Street Bets that launched GME to the stratosphere, in addition to value-minded contrarians like Dr. Michael Berry and arguably Roaring Kitty, that recognized the consensus-free money machine had overshot and was at risk of a messy unwinding. The GameStop short squeeze approximately began on August 31, 2020. After trading below $4 in August 2020, the stock saw several bursts of significant buying interest throughout the fall and winter, driving the share price up. A short seller in September may not have been too concerned when the stock ran from $4 to $8. An investor who may have made a lot of money shorting GME likely would not change their opinion on the company. It's still a sinking ship. But what about when the stock broke $10 in September? What about 15 in October or 20 in December? These months are where the actual short squeeze occurred. If new buyers force a short to close their position, it merely adds more upward pressure on the stock. But if shorts can overpower the longs, then they succeed at doubling down on their shorts at an incredibly attractive price. So it becomes a war of attrition. However, what appears symmetrical at the midpoint of the battle is anything but at the tail end of the distributions. This is because shorting a stock comes with significant risk. Shorting a stock at $10 means that your maximum profit is $10 if the stock goes to zero. It's a linear payoff with an upper bound. However, if you short a stock and the stock price goes up, the losses are still linear but with no limit on how much you can lose. So if the stock goes to $20, you will lose 10. If it goes to 30, you will lose 20, and so forth. This is problematic because you may not have those $20 to lose. Since a shorted stock is inherently levered, forced buying is the eventual outcome. This asymmetry is why you cannot squeeze longs. Forced covering makes a stock go up. Forced covering in a crowded short sends a stock to the moon. Again, a short squeeze is the meeting of asymmetric tails and forced covering. GameStop demonstrates several key points. Shorting GME was a smart and profitable trade for years, which attracted attention in a long-term self-reinforcing cycle. A crowded trade reached a tipping point where the risk to reward flipped, and the squeeze began on August 31st and climaxed on January 27th. Contrarians who recognized the squeeze ultimately made a fortune, while short sellers were completely wiped out. At the closing of 2021, it is apparent that GME was the Lexington and Concord of modern-day short squeezes. With this in mind, what if I told you the next short squeeze had already begun and that its impact on markets will dwarf that of GameStop, the Leningrad of all short squeezes? The next short squeeze will not be in a stock but rather a market financial product that is much, much more important today: volatility.